Walia, and I am with you with the topic of accounting and finance for bankers. Okay, so let's proceed with the class today. When we talk about our class today, we are going to talk about this particular attempt of JAIIB examination. I'm going to cover the area of AFB in this particular marathon. We'll be covering all the important questions, and also I'll be covering the area of the various concepts, so we are able to learn in a better way. So let's quickly move on and start the work. Okay, so we'll be covering the area of Module A, Module B, Module C, as well as Module D. When we talk about the Module A will have more of your numerical areas to be covered. Plus, when we talk about the Module A, it's a specific module which has more of the difficult content. When we talk about the Module B, the concept is easier. And at the same time, when we talk about Module B, there's one more thing that is there. That is, in terms of Module B, we'll find the working in such a way that there are more of half marker questions from this area, right? Then we have the Module C. Now this is equally important in terms of the practical area, just like Module A. Module C is equally important. And then we have the Module D, which is in the hands of each and every banker, because you are dealing with all those banking operations every single day, right? So that's the thing that is going to be advantageous for you. So give your best shot and let's begin with the class. Okay, here comes the first question for the marathon. The first question says the current assets rupees 20 lakhs, current liabilities are given 10 lakhs, the stock is of rupees 2 lakhs. Then what is the liquid ratio? 2 times, 1.8 times, 1.4 times, or none of these? Okay, so let's continue with the class. In terms of current assets and current liabilities, when we talk about the current ratio, in terms of current ratio, we take all the current assets divided by current liabilities. While under this topic, what we do here is we'll be taking current assets and we'll be deducting the area of stock or any prepaid expenses. Right, prepaid expenses along with this, and then we get the particular point to the area of liquid ratio. So when we talk about the liquid ratio is equal to liquid assets divided by the current liabilities. So under this area, what would be the answer? Under this area, the correct answer would be 2 times, 1.8 times, 1.4, or none of these. So when I talk about only and only the liquid assets, it would be 20 lakhs minus the stock of 2 lakhs, that gives us 18 lakhs. 18 lakhs is our liquid assets, and what we do here is liquid assets upon the current liabilities. Liquid assets are of 18 lakh rupees, while the current liabilities are of rupees 10 lakhs. So it would be 1.8 times. That's the correct answer for this question, right? So let's move on to the next question. The following balances between the cash book and entries and the cash book entries and the information in the bank statement have been identified. An amount incorrectly credited in the company's account by the bank, or lodgements into the bank not reported in the bank statements, or dishonor of a check, or the bank loan interest recovered by the bank. Checks drawn by the company yet to be presented to the bank. Which set of alternative correctly analyzes the treatment of these? That is, for cash book it's 1, 3 and 4. In bank we have 2 and 5. In cash book we have 3, 4 and in bank we have 1, 2 and 5. And then we talk about the cash book, we have 2, 4 and 5th statement, while in terms of bank we have 1 and 3. In terms of cash book we have 1, 2 and 3, while in terms of bank we have 4 and 5. So what would be the correct answer here? Okay, let's look at the point. In an amount incorrectly credited in the company's account by the bank. This is based upon the bank. Then lodgements into the bank not reported in the bank statements. That means this is something that has more or less doing with the cash with the passbook. Again, when we talk about the dishonor of a check deposited into the bank, the cash book has no clue when there is a dishonor, so technically that won't be recorded here. And bank loan interest recovered by the bank. Now bank has deducted that money and I had no clue about it till now, so technically this particular thing would be taken over in the cash book. And then we have the check which is drawn by the company yet to be presented to the bank. We have issued a check, we thought that the amount is gone, but it's not gone yet from our books of accounts, right? So then in this case what will happen is this particular point will also go in the cash book. So from this entire area we get point number B, that would be in cash book. Third and fourth is basically linked with that of the cash book. Third, fourth, and then we have in the bank we have 1, 2 as well as 5. So these 3 are belonging to our bank statements, while this 1, 3 and 4 is belonging to the area of the cash book, right? So let's move on. The correct answer is B. Next point. A bond whose par value is rupees 5,000 bears a coupon of 10.75%. That means 10.75% is its interest rate, is payable semi-annually. When we talk about semi-annually, that means this particular rate will be halved. Then has a maturity period of 4 years. The required rate of the bond is 8%. What is the value of the bond? Is the value of the bond 5267, 5480, 5259 or 5462? What would be the value of the bond? See, the point is, if it is paid semi-annually, that means the period is not going to be 4, it's going to be 8. And even the rate of interest has to be halved. That means to calculate the answer, you have to take 10.75 divided by 2 in terms of your rate. And in terms of your time, it would not be 4 years, it would become 4 multiplied by 2. That means it would be 8 times, right? So in this case, you have to calculate the value of the bond. That means we are looking forward to the present value of something that we are going to have in future. So what are we going to do here? First of all, you'll have to calculate the interest on the basis of 10.75 divided by 2. Whatever you will get, that would be your interest. And you are getting that interest for how many years? Whatever the interest rate is, the PV factor is calculated using this particular rate of interest, right? That would be 10.75 divided by 2, and that too for 8 times. And by the end of the 8th time, we are going to receive our 5,000 rupees back, right? 5,000 rupees back. That means present value of the 8th time only would be taken in this consideration. So what are we going to do? Let's calculate this question. The correct answer is going to be D. How do we calculate that particular thing? Let's we can also try that on the area of calculator. So let's open up the calculator and do it here. You have a similar feature in your calculators, whatever calculator you are using. So you can check it out on this area. First of all, we have 10.75. Now 10.75 is for the entire year. So divided it by 2, that gives us 5.375 is going to be the interest rate. So when we use this point as an interest rate, how do we deal with it? Okay, so when we talk about this area, first of all, we will have to take up the area of the value of the bond using the PV factors. In terms of the PV factors, so it is going to be 5.375. So whatever value is 1 plus 5.375% is to be added. So it gives us 1.05375. So if we have 1.05375, 1 divided by 1.05375, this is the point which we are going to use in terms of the PV factors. So when we're taking the PV factors, here you have to click on equal to, whatever the value will come for 8 times is going to be your present value. This 268.75 is calculated on the basis of this amount. See, this was 268. That means they have taken the semi-annual interest in terms of one particular year, right? So in one particular year, whatever the interest rate is, the interest rate was 5,000 multiplied by 10.75. What I did was I did half of 10.75. That came out to be 5.375. Now for PV factor, I'll have to use that interest rate only. That is what we are going to choose here for the working. Okay, the required rate of return was also given, so I'm going to take that one. If the required rate of return was 8%, it's given in the question. The required rate of return is 8%, so I'm going to half it up. That means divide by 2. This would be used for the PV factor. That would be 4. That means we have to add 1 plus 4%. That gives you 1.04. So for the question, I'm going to use 1 divided by, it's going to be 1 divided by 1.04. So this is the PV factor. For the first one, it's going to be 961. We have got 8 times. So it's going to be 4% and 8 times. Kindly correct it. It would be 4% and 8 times. Why? Because there are overall 8 times you're getting the interest, and our required value was different from that of interest. If the interest was 10.75, but for the PV factor it is written, the required rate of return of the bond was 8%. So what are we going to do? 1 divided by 1.04, because 8% has to be halved. So we have got 1 divided by 1.1. This is the first one. Put it in the memory. If you have the GT function in your calculators, you can put it there. Now, this was the first one. Then go ahead. This is your second value. Then third value. Then fourth value. Then fifth value. Then sixth value. And then seventh value. And then we have the eighth value. Since I'm showing it in your digital screen, then it becomes a little difficult, but you can do it on your calculators. Just click on 1 divided by 1.04 8 times. By clicking on equal to, you will get the value there. It would be 6.7327, and for that 5327 we have got for the last year, it comes out to be this. This is correct. Right? So then when we look at the MR, it's going to be 6.64. I think I missed out one point in the memory here. Correctly, you are getting 0.7307 in the last year, and the total of 1 divided by, if I have to calculate, it would be 1 divided by 1.04. This is what I did for 8 times. So every time I'm doing it, I am putting it in the memory. There I get that particular point. Right? That comes out to be 6.7327. While going through this video, kindly do it with me and check it out whether your answer is also coming the same. This will help you in your examination, because this particular bond valuation questions are idly there in the examination, that too with a higher weightage. So we have to be very clear how we are dealing with it. So I've shown you how you're going to calculate 6.7327, and whatever your value was for the last year, there you got 5,000 multiplied by 0.7307, and your answer came out to be 5462.91. Now let's head back towards the question again. Okay. So before I move forward, let's talk about a particular concept as well. The concept here I'm going to talk about is the capital expenditure and the revenue expenditure. The questions from this era is asked a lot in the examination. So let's understand what is the difference between the two. When we talk about the capital expenditure, these are those expenditure we are losing money, but we are losing money because of the fact that we are spending on our assets. So if we purchase an asset, or that is something which lasts for more than a year. Assets, that means the long-term assets. If I purchase a particular asset, that means I can purchase a particular plant and machinery, I can buy a building. These are used for an year or more than that, right? So whatever is used for a long-term period would be a part of capital expenditure. When we talk about the revenue expenditure, it refers to all those expenditure which you are making during the year. Stationery expenses, or you can say salaries, wages, all these things that you are paying to the people who are working with you. That is, you are giving that particular amount only for that particular year, where matching concept hits in. We're going to talk about the matching concept too. So let's come back towards the revenue expenditure which is done during the year. There are questions, they give a particular point and they ask you whether it is a capital expenditure or it's a revenue expenditure. So we have to be very clear which particular expenditure they're talking about, right? So this is about the capital expenditure and the revenue expenditure. And if they ask about capital receipt, if I sell an asset, then we have a capital expenditure, capital receipt. If I receive income because I am doing my regular work, it would be called a revenue receipt. That's the difference between the two. One is called revenue receipt, the other is called the capital receipt. Now, let's talk about the preliminary expenses. Then discount allowed on issue of shares are examples of. When we talk about the discount preliminary expenses, these are those expenses which are incurred before the incorporation of the company. Before the company came into its existence, these expenditures were there. So preliminary expenses, discount allowed on the issue of shares are the examples of capital expenditure, deferred revenue, revenue expenditure, or none of these. When we talk about preliminary expenditure, its sibling, that is pre-operative expenditure, or when we talk about advertisement suspense, all these other different expenditures are a class of deferred revenue expenditure. So the correct answer to this question is going to be deferred revenue expenditure. Now, let's move on and deal with the next question. The question says the expenditure incurred in acquiring the patents. If you are acquiring any expenditure because you are getting an intangible asset, what will you call it? Will you call it a capital expenditure, deferred revenue, revenue expenditure, or none of the above? When we talk about acquiring the patents, when we are acquiring them, that means we're generating an asset. When we are buying an asset, we are making a payment. It's going to be a capital expenditure, right? So the correct answer to this question is capital expenditure. Okay, the next point, it says the cost of replacement of defective parts of the machinery. Since we are just removing one part of the machinery and replacing it with other part, technically, are we increasing the capacity of that machinery? No. Are we bringing something new to the machinery in terms of productivity? No. Are we making that machinery an improved version of itself? No. Wherever it was, we're just maintaining it that point of time. So what would it be called? Capital expenditure, revenue, deferred revenue, or none of the above? Since in this case there's a cost of replacement of defective parts of the machinery, then we are just removing those specific parts and bringing new ones without making any changes. It would be called a revenue expenditure, right? So the correct answer here would be revenue expenditure. Now moving on to the next question. It says the loss of goods due to fire. See, the point is a revenue expenditure, because when we talk about the loss of goods, there was a specific fire in the organization, and because of that fire, a good amount of goods have been disrupted. We are not able to we are not able to sell those goods correctly, right? Because now it's damaged, it's burnt, who will buy that? So what is happening is we call this expenditure a revenue expenditure, because technically there's a revenue which we could have generated if we would have sold that stock. But currently what are we dealing with? We are having a revenue expenditure because of what reason? Because it's recurring. Losses don't happen every day. Then in terms of amount involved is small, the losses arising out of the business operations, or none of the above. The exact reason why this is happening is because of the business operations. See, I was making money in the business. While making money in the business, I lost a little chance of earning because that stock got burnt. See, that stock is burnt now. So technically, I'm not able to generate money for my business because I got that particular stock for this particular purpose, that I'll sell it and I'll generate money. So technically, in this case, the correct answer is going to be C. Right? Now, moving on to the next question. Okay, this is another important concept to be covered for the examination, as many a times you'll find major questions coming from the area of accounting concepts. So quickly, let's revise all the accounting concepts. When we talk about the various concepts of accounting, it has been broadly classified into these following areas. Number one, that is basic assumptions of accounting. Number two, the basic principles of accounting. Number three, the conventions of accounting. When we talk about the basic assumptions of accounting, the basic assumptions states that there are certain things in accounting which are going to be the hardcore base of it, the foundation of accounting. Number one is business entity concept. It says that the business and the person, they are two different things. Once a particular person gives his money to the business, then it's the responsibility of the business to generate money for him. Technically, in this case, he is getting money, and the business has to make sure that business is able to generate something for the businessman. That's why we call it capital when a particular person brings his money to the business, and when he withdraws it, we call it drawings. So that particular concept is because of the business entity concept, because business and the person, even if he owns it, they are two different set of things. Secondly, accounting period assumption. When we talk about the accounting period assumption, we divide the life of the asset into the following types. How do we divide it? We divide the life of the asset into the following, into different years: year 1, year 2, year 3, year 4. Since it's divided into different set of years, we call it an accounting period concept. When we talk about accounting period concept, we divide it into different financial years. One particular year means 1st April to 31st of March. See, the point is, I cannot study the entire book in one particular day if it is not divided into chapters, it is not divided into subtopics, when it is not divided into question format and summaries. This makes easier to understand a book. Here we are trying to understand the entire life of a business. So technically, how can we study it all at once? That's why we divide it into different topics. So the point would be, accounting period assumption divides the entire life of the asset into small bits, and you study it yearly rather than studying the entire life of the business together. Third point is assumption of money measurement. Money measurement means anything which can be measured in terms of money or rupees is basically considered as a assumption which states that everything which is capable of being determined or measured in terms of money, only that would be recorded, nothing else. Next point that comes is going concern assumption. Going concern assumption says when we build up a business, we do not build it for a day. We do not build it for two. We are investing a good amount of money. We buy assets which are long term. That means we know that the business is going to outlive the life of the asset. If the asset's life is 10 years, 11 years, this business is going to stay forever. So technically, when we talk about the going concern concept, the depreciation concept is a part of this. We charge depreciation on those long-term assets, thinking that no, the business is going to stay for a longer period of time. So we are charging depreciation for every single year, right? Then the next point is basic principles of accounting. What are the various principles of accounting? When we talk about the concepts of accounting or principles of accounting, first one is dual aspect. Sometimes it is also called the balance sheet equation method. Under dual aspect, we have all the capital and all the outside liabilities. We ask other people to put money to the business as well. So capital plus liabilities is basically, they become assets, right? So in this case, the dual aspect principle says every debit is equal to credit. And how do we put it? If I put 100 rupees in business, it can be entire 100 rupees is bought by me. That means it's capital. We don't have outside liabilities. But if I have got 60 rupees in the business and the business valuation is total 100 rupees, that means proprietor got 60 rupees, the other person got 40. So there are two kinds of liabilities, that is capital plus the different liabilities. Next point that comes here is revenue recognition principle. in terms of revenue recognition principle, it says you should recognize the revenue only when it becomes due. You should have a proof, only then you should recognize a revenue. It can be on the due basis, it can be based upon if you have received cash for that particular purpose. So technically in this case the correct answer would be the revenue recognition principle would relate to any concept which talks about we have a proof, let's record the particular income, otherwise we will not record it as income. Next point is historical cost principle. It says once you buy a particular asset, then note it down after you have bought that asset and what value you have bought it at. So that would be the point to be covered here. Then the next point, when we talk about the cost principle, this is the reason that we have, see, the point is if I've got a machinery, I start putting depreciation concept on it. That means the machinery was bought at 10 lakh, was used for n number of years, but the book value or the cost remains the same. We do not include the concept of inflation into it because of historical cost principle, because we cannot change the value of that asset every now and then, and we have to recollect and recalculate the entire depreciation just because we are not following the historical cost concept. Just to remove the part of inflation and the changes in the valuation of those assets, we record only the price at which we bought it. Then matching principle. Matching principles, a few students, I've seen bankers saying that this is debit equal to credit, but that's not the concept in terms of the matching principle. Matching principle says whatever income we have earned during the year is because of whatever expenses we have incurred during this relevant period only. So the correct answer for this would be the matching principle is equal to all the expenses incurred during the year are related to all the incomes that we earned during this particular year. Profit and loss account is based upon the matching principle. That's why we record all the expenses and all the incomes which relate to this particular year only in this account. Then we have the objectivity principle. Objectivity principle says if you are making the books of accounts, you should also keep the documents. It should be verifiable. If I say that, okay, I have rupees 100 spent on petrol, so I should have a particular receipt of that particular transaction, only then you will be considering it. Otherwise it will not be a part of it. So objectivity talks about reliability of the particular content. If you said something, it is as per that particular scenario. That is what we'll talk about objectivity principle. Then we have the conventions of accounting. In terms of conventions of accounting, conventions mean everything that has been traditionally going on in the business world, right? That means convention means whatever the business has decided, no, this is going to be like that. Whatever it takes, this is how we are going to do it. The first point is convention of full disclosure. We disclose everything. That means whatever the business is doing, it has to be known to the people so that there is complete transparency and the person knows where he's putting his money. Then convention of materiality, record only if you have to specify. See, this is an extension. Remember, materiality is an extension of the concept of full disclosure. There are many questions which are in the previous examinations, even there had been multiple questions which are asked from this particular slide. So we expect that yes, there can be questions from the various concepts of accounting. So do it in such a way that you know the entire concept. Now, when we talk about the materiality, it's an extension of full disclosure. When we talk about materiality, if I ask you something, you will tell me the information which is relevant for my decision making. So you will not tell me everything, but what is exactly relevant and is required for my decision making. So materiality is basically a chunk of the full disclosure. Then we have the convention of conservatism. Conservatism talks about the fear of a businessman. He is basically someone who's getting scared of the fact that what if I lose money. So he anticipates all the losses, but he is not allowed to anticipate all the profits. So the conclusion of this principle would come out to be anticipate the losses but not profits. It's not allowed to anticipate the profits before you get that profit, but it is allowed to record the losses before we are generating it. That's what the principle of conservatism talks about. The other name of this principle is prudence. At least one question is always there in the examination from the concept. It can be more than one even. This is a very important concept, the entire conceptual area. Then convention of consistency. Consistency says you can, if you want to change the method, go ahead and change the method. But what you are not allowed to do is you cannot continuously switch from one method to another. So that's what we talk about in terms of all the concepts of accounting. Give a quick look to it and then we'll move on. Okay, so let's move on towards the next topic. Here comes the first question towards the area of concepts. It says a number of notes are appended to the balance sheet by companies, which include information such as contingent. There are many notes that we attach with the balance sheet now that would include contingent liabilities, market value of the investments. This is due to the compliance of which of the following accounting concepts: business entity, money measurement, realization, and accounting for full disclosure concept. When we talk about this particular area, what happens here is, see, there are so many notes we are providing. Why do we provide these notes? Because we cannot misguide or mislead our the potential investors of the company as well as who's already an investor of the company. So in this case, the correct answer that would be coming up is because we have to disclose everything. It's a convention that whatever the organization is doing, they need to clearly specify it to the businessmen, right? To the shareholders, to the businessmen, or anybody who can be affected by the company's transactions. So correct answer is accounting for full disclosure. But the question itself said we are providing so many notes and all. Why do we provide it? Because people are supposed to have it, right? Then comes the next question. Just the next question, we have just talked about it. The depreciation a method in which the depreciation is calculated on the principle that the asset loses an equal amount of value every year. Now, this is a concept of depreciation. Every year you lose only a specific amount of the depreciation. The depreciation is fixed. So which particular method is used? Written down value, sum of years method, double declining method, or original cost method? What would be the correct answer in this question? The correct answer in this question is the name of the method is fixed installment method. We also call it straight line method, and we also call it fixed percentage method. For fixed installment, percentage can go up to in terms of WDV as well. So these two plus original cost method. These are the three different names of the method that we're talking about. Since the amount of depreciation doesn't change every year, it remains the same. That is what we'll be considering. The correct answer is D, original cost method. Now, let's move on towards the next question. The next question is, if a firm receives advances against the purchase of the goods from a customer, the company is receiving money because some customer has given them money in advance. It does not take this income or sale due to which of the following concepts? Basically, there is no sale yet, there is no purchase yet, there is just an receiving a chunk of it as an advance. But right now they are not recording it in the books of accounts. Why aren't they recording it? Is it because of realization concept? Is it because of revenue recognition? Is it because of conservatism or going concern? There was one particular concept that I didn't tell at that point of time that was missed out. That is realization concept. Revenue recognition talks about when are we going to record the amount that we are receiving in terms of when we have a fixed amount of sale that we might make. That is what we call revenue recognition. But when we talk about the area of see, if I receive cash, I have a surety, the transaction is done. That is what we called with realization. We realize the money. So in this case, realization concept talks about receiving in cash, while the revenue recognition concept talks about due or received. Whatever is there, we'll record accordingly. This is more sound. While when we talk about the realization concept, it says whenever you receive cash only, then tell me, otherwise I'll not record it. That's the concept which they follow. And in this case, they are saying that whatever advances are received, you have just received the advances yet. But let's wait. Since the point is the advance is received, there would be chance that we'll be receiving the future money as well. So that means the amount is due. Let's record the advances as an asset. but later on we'll record it as an income. So that means we are considering a part of that particular scenario. The reason is revenue recognition principle or revenue recognition concept. Now, moving on to the next one. Which of the following event or transaction shall not be recorded in the books of accounts? First, okay, this is the first one. It says a compensation paid to the worker by the company for injury during duty hours. There was an injury during his duty timing. Adverse effect of performance of the company due to ill health of the managing director. Then write off of the account of a trade or director who died, trade debtor who died after the meeting and accident, or all of the above. Which of the following shall not be recorded in the books of accounts? First is the compensation paid. See, the point is, if there's a compensation paid, the amount is already given to us, a money measurement concept is there, so technically in this case it has to be recorded. Then adverse effects of performance of the company. The company is going through adverse problems because the particular MD is not feeling well. Now this is something based upon the quality, not in terms of the quantity or in terms of measurement of money. So technically this is the point, because in terms of write-off it can also be given in terms of numerics. So there's one particular point which is only and only regarding the quality, that is point number B. Right? Adverse effect of the performance of the company due to the ill health of the director. This is not in terms of money. It has to be in terms of money in order to become a transaction in the accounting area. Now, let's move on and talk about the next point. When we talk about a double columnar cash book has two columns in each side, which one is false? Now it's about the cash book, a part of the module B. It says one column is meant for cash and the other column is meant for discount. The discount column on the debit side represents the discount allowed. The cash column on the credit side represents the cash received. The discount column on the credit side means the discount allowed, and the cash column on the debit side means the cash received. It's a two-column cash book. Let's make a two-column cash book for a better purpose, because the statements seems to be just too confusing. So now let's make it here somewhere, right? Double column cash book means we have cash and bank here, we have cash and bank here. This is cash, this is bank, this is cash, this is bank. This is your debit side and this is your credit side. This is how a particular cash book looks like. This area is called the receipt side, this area is called the expenditure side, right? Whatever payments we are making. So this is receipt side and this is your payment side. In terms of the cash book, the first point says one column means cash and another means the discount. Then we have the discount or column of the debit represents that is debit side at the discount allowed. Then this is also correct. This is also correct. We can have cash and discount. We can have bank and discount, right? We can have bank and discount as well. So first point is correct. There are three elements: cash, bank, and discount. Whatever you want to switch, you switch over. Then the discount column on the debit side is basically represents the discount allowed. Expenses are debited, so discount allowed is also there. The cash column of the credit side represents cash received. That's also correct. So in that case, if all the first three are correct, this correct answer, the incorrect point is going to be the discount column on the credit side means discount allowed. Expenses are debited. We are allowing someone an expense that, sir, you cannot pay me the entire amount, it's fine, just pay a bit of it, the remaining is your discount. We are basically losing a part of our money. So it would be covered under the point D, right? That's false. Now moving on to the next point. Which of the following accounting standards help in better understanding of financial statements? There were many bankers who have constantly asked, ma'am, what should we do regarding the standards? Remember, you cannot go through all the standards in detail. What you need to know is what is the sequence, what is the number of the standard that can be asked in the examination. So this is one of the questions which is just like the questions that can be asked from the AS in your examination. Quickly go through the question. Which of the following accounting standards help in better understanding of the financial statements? Okay, so let's move on. When we talk about the following, which of the following accounting standards helps in better understanding of the financial statements? See, if I explain things properly, only then the person standing in front of me can understand things. That means I have to be crystal clear with whatever I'm coming up. That means in this case, it's going to be disclosure of the accounting policies. Disclose the points now, whatever is important, whatever is relevant for decision making. Disclose that part first. Only then the person can have a better understanding. Otherwise, if we are going to be clearing up things on the basis of filtering it, now this is important, no, this is not, then how will he decide being unbiased? Because you can be biased while giving the information to them. That's why we say it should be fully disclosed to the other person. So it is basically disclosure of accounting policies. That is point number A. Now moving on, which of the accounting standards does not match? Now comes the match of the following. Match the following thing. AS 17 is segment reporting. AS 20 is CFS or consolidated financial accounting or consolidated financial statements. Next point is accounting standard 26, valuation of intangible assets, or AS 29, provision, contingency, liabilities and contingent assets. Okay, since we are covering up the concepts, what I am trying to do is I am giving you the concepts as well as MCQs, and with every MCQ, whatever new is also coming up, I'll be covering it in that way, so that your preparation is not just limited to the MCQ, but you are directly associated with the concept. So in the examination, at least you are able to crack even if the question isn't the same, right? Okay, now when we talk about the segment reporting, its reporting is based upon the assets, profits, as well as the turnover of the organization. That is there in terms of segment reporting. Then when we talk about 26, its valuation of intangible assets, AS 26, that goodwill is valued under this. AS 29 is also relating to provisions. Certain amounts, we know that we are supposed to pay this money in any case. For example, provision for depreciation. Depreciation is going to be charged in any case. So that means provision is there. Then we have the contingent liabilities, any liability which we are not sure about. It may or may not become certain in the upcoming future. So these kind of liabilities are not certain yet. So then correct answer would be contingent liabilities and contingent assets are those assets which are uncertain, those liabilities which are uncertain, and that's why we do not even put it in the balance sheet. They all fall in the footnotes, right? In this case, the correct answer would be B. AS 20, why? Because AS 20 is EPS. Whatever money you earn in an organization, that is earning per share, is the financial ratio. That is what is the that is earning of the organization divided by number of shareholders, number of shares in a company. Whatever earning is made per share is called earning per share. So it's an important area to look forward to. The correct answer is B. B is EPS. Okay, before we move forward, just a specific revision of what do you mean by the 6 pillars of accounting. When we talk about the 6 pillars of accounting, they are okay, where's the 6th one? C, R, A, D. One is missing, that is L. In terms of the 6 pillars of accounting, we can learn it as cradle. In accounting, when we define things, it can be based upon 2 teams, debit as well as the credit. The debit team here has taken assets. This is your team debit. And when we talk about this is based upon the modern accounting. Then we talk about it. Number 1, capital account means the account of the businessman, whatever money he has deposited into the business. Drawings, whatever money he withdrew from the business. Technically, it is covered. C, the capital is covered in the area of credit. C for capital, C for credit. When we talk about D, D here stands for D for drawings and D for debit. So when we talk about other areas, whatever thing that helps us to generate more money is called asset. whatever we spend upon in order to earn money is our expense. If my money falls short, I don't have enough money to cope up with the expenses that are incurring, then what do? We take loans. That is our liabilities. Just written there, it is a part of our liabilities. And when we talk about why are we working so hard, why would a particular person put so much of efforts and so much of money into his business? Because he wants to generate revenue, which is also called income. So in this case, the correct answer for the cradle, C for capital, R for revenue, A for asset, D for drawings, L for liabilities, and E for expenses. So there are two teams. Remember, in the question, even if they trick you or they try to trick you, always remember just three elements out of the debit or credit. Just learn one particular team, the other one would be known to you. Just remember the term acronym. Then that is cradle, assets, the drawings as well as expenses. All these three things are always on the debit side. That means whenever asset is increasing, whenever drawings are increasing, whenever we have an expense which is rising, it would be shown in the team debit. It would be shown on the debit side. What if we are losing any of these things? We call it team credit, right? So that is if the amount is going down, then we'll credit it. While liabilities, when liabilities increase, it's shown on the credit side. When we have income increasing, shown on the credit side. When we have capital increasing, we show it on the credit side. So you can learn any of these particular teams, and if you are dealing with it, just be sure in the examination that you remember only at least three, because any of the journal questions can be solved very easily by following these rules. Right? Now, moving on. With the 6 pillars of accounting coming here, let's move on to the next question based upon the concepts of accounting. Now, the question says many small transactions are not recorded separately. We do not go ahead and record it separately. These are included in the miscellaneous items for the recording. This is done because of convention of materiality, convention of conservatism, convention of account for full disclosure, and convention of consistency. What would be the correct answer in this question? See, we are not giving the entire information. We are just putting anything which is extremely important for the organization. If only the most important things are noted down, so where will we put it? We'll put it in the convention of materiality. What is extremely material or extremely important for the business? Only that portion would be noted, right? So in this case, the correct answer is A. A convention which states that what are we recording in the business. They say we are going to record only that part, or we are going to tell the other person only that part which is relevant for the business, because we will not record, we will not give any other information which is extremely confusing to the business. Okay, moving on to the next question. The next question talks about DSCR, the debt service coverage ratio. How do we do this? It says the amount of the term loan is rupees 10,000 per month. The EMI is given. Monthly average interest on the term loan is 5,000 rupees. And then this is principal and interest if the amount of depreciation is 30,000 per annum. The profit after tax is 2,70,000. What would be your debt service coverage ratio? Is it 1 or 1.5 or 2 or 2.5? First of all, when we are going to calculate the debt service coverage ratio, that means whatever profit we have before depreciation and before these interest. So, how do we calculate profit before depreciation? What we have is PAT, that is after tax we have 2,70,000. So, let's add back a few things. Number one, let's add back the depreciation, because the depreciation is a non-cash expense. So, we still have this much amount of money in our bank accounts. Plus, the interest is still going to be paid in any case, so we'll add it before that. See, these ratios are based upon the fact that whatever money you make before paying the interest, that amount determines whether we can give you more loan or more interest can be paid by you smoothly or not. So what they do is, that is your profit after tax, then we add back the depreciation, then we add back the interest that we are paying, that is rupees 5,000 divided by, see, there's a specific amount of money which we are paying in any case, that is 10,000 for the loan installment plus 5,000 for what? For the interest. So the correct answer would come out to be C, right? It's going to be 2,70,000 plus 30 plus we have the area of, oh, there's one more thing. This is for per month, na? So if it is for per month, then we multiply it by 12. It was 5,000. Monthly average is 5,000. Then multiply it by 12. How am I calculating it? Why am I multiplying it by 12? Just because it is based upon the monthly averages. Monthly average. Monthly average means it's basically for every single month. It's noted separately. So it is going to be, so the correct answer is 2. It is 2 times. The rule of this ratio is higher the ratio, better it is. You can raise more loan and you have, in this case, you have less financial risks, which is a healthier thing for the organization because it can still take more loans. Okay. Moving on to the next question. Which of the following statements is correct? It says what the required rate is equal to the coupon rate and the value of the bond is equal to its par value. Now B point, I'm sorry about this. These are the points that are given. This is from the area of capital budgeting. Then the first point is whatever, see the point is, it says where the required rate of return is equal to the coupon rate, the bond is equal to the value, par value. This is bond valuation. When we talk about it, see, whatever I wanted and whatever the bank is given, the person is giving from whom we have purchased bond, it's good for us. Then we have what the required rate of return is greater than the coupon rate, the value of the benefit is at par, bond is at par value. Then last is where the required rate of return is less than the coupon rate, the value of the bond is greater than its value, or all of the above. Which particular point is correct here? Okay, there's one point there. The first point is correct. Where whatever we wanted. See, if I wanted a particular rate of return and that rate of return is my yield even, whatever the amount we are being given and whatever I expected, it's the same. Then that means it's a good point. We are making good amount of money. Bond valuation is correct in this case. And then the C point, it says where the required rate of return, whatever you expected is less than the coupon rate. That means if you expected this, the company is giving you this, then you are really happy with that point. Now, where the value of the bond is greater than its value. So this is also correct. The first one is also correct, but I am dicey about the third point. Second point, it says where the required rate of return is more. Our required rate of return is more. That means I am expecting 10%, 15%, while to the coupon rate, the value of the bond is less than, okay, it's less than. Correct. This is also correct. See, I expected that the bond is going to be this much amount of return, while it is here somewhere. That means we are not able to reach up to that limit. So in this case, the correct answer that is going to come is all of the above. All of these are correct. See, in a basic language, subtle language, if I expected 10 rupees and you gave me 12 rupees, then this is good for me. Right? So I can pay you more because wow, the company is giving me good amount of return. So why don't I look forward to it and invest more? Right? We'll become more selfish towards it. What if I expected 10 rupees and you gave me 9? So what will happen? I'll not buy your bond again. I'll say this company is not paying me enough. The value is declining every day. And if I expected 10 and I got 10, then I'll be really happy with it, isn't it? So in this case, the correct answer would be D, all of the above. These all are correct. Next point, which one of the following statements is true? Number one, the capital expenditure does not affect the profitability of the business, but revenue expenditure does. Second point says, then we have the area of capital expenditure affects the profitability of the concern directly, but revenue expenditure does not. And capital expenditure affects the profitability of the business or indirectly, but revenue expenditure directly. Then both expenditure and these are affecting the concern directly. ऐसा नहीं होता. This is not the point. See, the point is, if I buy an asset, the asset can really help my business. But how? If I invest money into the asset, that asset is going to generate more revenue for me. It would produce more, so I can sell more. Then I can generate more. Technically, the revenue expenditure that we are making, that affects our profitability directly, right? When we talk about the capital expenditure, it will not, if I buy a particular asset, it will never add more profit. What happens is, because I generated a good asset, that asset generated good income for me in future. So in this case, the correct point would be capital expenditure affects the profitability, but it affects it indirectly, while revenue affects it directly. So the correct answer is C, right? Moving on to the next point. This is related to assertion and reasoning. Given below are the two statements, one labeled as assertion, the second one is the reason. So what would be the answer? Sinking fund is charged against profit, then sinking fund is created for a long-term liability, and in the above statements, which one of the following is correct? Is both the points correct or one of them is correct? See, sinking fund is basically, we know that after a certain period of time, we are gonna pay a good amount of income, good amount of payments have to be made after a certain period of time. We are scared today. Why won't be scared today? So what we did was, because we were scared, we kept a part of the declining or the future amount that we need aside. We started keeping it aside. See, every year I started keeping 10 rupees aside. And these all rupees are not only just kept aside, it's invested further in the market. So whatever returns it gives you, we are going to add it up and create a fund. And by the end of the time, when we have to incur that huge expenditure after years, we will use this money for the payment. So technically, then at that point of time, not a major portion of your assets can be lost. That's a systematic planning. Since the value of the asset is declining, we'll keep a specific amount aside, invested in the market, we earn and then put it back into the fund. That's called the fund-based accounting. So in this case, both the points, it's a charge against profit, because when we make profit only, then we transfer the money to the sinking fund there, right? Then in terms of repayment of long-term liability, it helps you to repay a good amount of money, because you know that you can divide it into good amount of years, and then the burden would be less by the time you'll be making the actual payments. So correct answer is both of these topics are correct. Okay, now let's move on and talk about depreciation. Under depreciation, what do we do? Under depreciation, when we talk about this term arises because of our usage of asset. Think about it. We are using the screen. We are using these pens every single day. Will you buy the same screen for the same price? You know, you'll not buy it. Why? Because the asset's value is declining over the period of time because of its regular use. So what are we going to do it? Depreciation in your examination be around 4 methods that we use, right? First one is straight line method, then is WDV method, then the next one is no, not 5 or roughly 5. Then we have the sum of digit method. The questions have been asked from this area as well, sum of digits method, and then we have the area of double declining. There can be practical questions from this area. So I'll be covering all the these methods in different form of numerical questions. And the last one that we'll be covering is sinking fund. We have talked about it. It's also used in acquiring the new assets. So these are the 4 methods that we'll be using in terms of depreciation. Okay. Now I'm starting with the first method, that is sum of the straight line method. Under straight line method, what do we use? One particular amount being reduced every single year as depreciation. On 1st April 2013, Kanu bought machinery costing rupees 80,000. On 1st July 2015, machinery was sold for rupees 40,000. Prepare machinery account from 1st April 2013 to 2015, assuming the depreciation was charged 10% per annum and on 31st March every year on the basis of original cost method. This is the case study that they have given you. Now, how will you solve the question? The question says the value of the machinery at the end of the second year, not the first year. They are asking the value of this machinery at the end of second year. We bought it on the 1st April. Okay. 2013 to 2014 is the first year, and then let's look forward to it. 2014 to 2015 is the second year. When are we selling it? We are selling it in the next year, that is in 2015 to 2016. In the mid somewhere we are selling this particular asset, actually by the end of the first quarter, right? So now prepare the account. Let's look at the point is going to be 10% now. What is going to be the value of machinery by the end of second year, right? The value of the machinery was 80,000. In the first year, the depreciation that could be charged was 10%. That means we were left with 72,000. Now, from that 72,000, you will have to deduct the same amount of depreciation, because under this method, what do? We record the depreciation of same amount for every year. If the value was 80,000 for the first year, for the second year, it would be 72 minus 8. It comes out to be 64,000, right? This is for the second year. For the third year, remember, if the question says for the third year, we will not charge depreciation for the entire year because it's used for barely 3 months, right? So in this case, the correct answer is going to be 64,000. These kind of questions can be asked, and sometimes they've also put the area of find the loss and the profit of the sale of that particular asset as well. So we have to be very clear how we are dealing with this problem. Same question. The question says, what is the loss on sale? We are selling the machinery. Let's note it down. The opening value of this machinery was 80,000. Used for 3 years. That means from 2013 to 14, 2014 to 15, and 15 to till 1st of July. So what are we going to do here? 1 full year, 2 full year, and 3 months here, right? So what are we going to do here? This is 8,000 for the entire year. Since the amount doesn't change, always remember in depreciation, original cost. Original cost means whenever you have to calculate the depreciation, it's on the original value of that asset. So if the original value was 8,000, so we're going to calculate the depreciation on 8,000 only. It is 8,000 for the first year, 8,000 for the second year. What is the value for the third year? Is it 8,000 complete? No. How are we going to calculate it? Let's take up now. It comes out to be 8,000 is for the entire year. Now I'm taking up 8,000 multiplied by, okay, One more tip, whenever you're going for the examination, make sure if you're using the memory, you clear up the memory while doing new calculations. Otherwise, it can get into your memory and your answers can come wrong wherever you use the feature of memory again. Right? Now, when we look forward to the question, it's 8,000 now. 8,000 multiplied by how many months? We use it for 3 months. 3 divided by 12. That comes out to be 2,000 rupees. That means 8,000 for the first year, 8,000 for the second year. That means 16,000 gone, and also we lost 2 more. So that means we have 18,000 of total loss of the organization. Oh, yes. It's 8,000 for the first year. It's 8,000 for the second year, and for the third year, it's going to be 2,000. So technically, we have 18,000 of total amount that is covered under the area of depreciation. So out of 80,000, we have sold something for barely 40. There is a major loss, and the amount of loss would be 22K, 40K, for 80 or 68. It's A, B, C and D. What would be your answer then? See, 64,000 was left by the end of the second year only. So let's just charge the depreciation only for the next year. Na? For the first year end, we had okay, one more way I'm telling you, for the WDV method also, this is helpful. Opening, depreciation and closing value. First one, it is 80,000 minus 8,000, that gives you 72. Then we have 72 minus 8, it is 64. Then we have 64 by the end of the year, it is 62. While we are selling it for 40, we are selling it in pennies. Why? Then if this is the book value, your sales value is 40,000. The correct value of your loss would be rupees 22,000. Is this your answer? Kindly go and check it out. Okay. Take a moment and calculate it, please. Okay, done. Let's move on and move towards the next question. The correct answer is 22,000. Okay, the next question is based upon the depreciation as on July. We are already done with it. Now, since we are already done with it, what was the depreciation in July? See, the point is, we started using it for the third year as well. Now, 1st April till 30th of June. Please remember, we will not include the value on the first day of July at all. We'll have to include any particular time period before this period, because ultimately in July we stopped using it. So we won't take the depreciation for one day. So that means in this particular question, what we are going to take is 8,000 is for the entire year. So what would be the value for 3 months? 3 divided by 12, it comes out to be 2,000, right? We have calculated it while we were calculating the loss for this year. So correct answer is A. Okay, now moving on to the next question. It's 2,000. Okay, here comes the next question. Oh, this is rupees, everyone. Right? So what is the question? A boiler was purchased from abroad for rupees 10,000. We got it from a foreign country and we got it for 10,000. We had to pay the shipping charge and the forwarding charges. Then we were supposed to pay the import duty, expenses on installation. Now here we are putting two things together. We are learning the topic of depreciation, along with this the concept of capital expenditure, the expenditure which we incur on the basis of various assets. So that would be 10,000 plus 2,000 plus 7,000 plus 1,000. The total amount which we have spent when the asset is ready to use, till the moment when the asset is ready to use, what is the amount? It would be 7 to 10, 11. Okay, this means this asset will cost us 20,000 all in all. Knowing the cost is important. What if I pay for a second hand machinery, and that too we are paying the overhauling expenses before putting it to use? If we are doing it before putting it to use, this would become a part of the capital expenditure. But if I spent on the service, if I spend on repairs, it is always a revenue expenditure, not a capital expenditure. So these are very important points. You can lose marks because you might not be looking forward to these basic concepts. So in this case, the value would be 20,000. They say calculate the depreciation for the first 3 years separately. They are asking the balance for the third year. Now, let me give you a trick for this. If 20,000 is the value for the first year, second year and third year, 20,000 is the value for the first year. They are not asking you what is the value at the end of the first year, second year. No. They are not even asking the depreciation. They are just asking the value for the third year, right? So what are we going to do here? What we will do is we have to take 10%. 10% of this machinery is lost every year, correct? That means 10% is gone. Right now, 10% is gone. We are left with 90% of 20,000, isn't it? It would be 18,000. This is the value for the second year. Let me show it to you in terms of your calculator as well. Here comes the calculator. Now, the value says you'll have to calculate the balance for the third year. For the first year, it was 20,000. Either we take one way, 20,000 minus 10%, 20,000 minus 10%, that gives you 2,000 is gone, right? Then it is 18 minus 10%. That means by the end of the second year, is it going to be 16,200? First year, opening value of this asset was 20,000. For the first year, depreciation was 2,000 rupees. For the second year, depreciation was 1,800 rupees. For the third year, when we depreciate it further, it is going to be 1,620 rupees depreciation. The value comes out to be 1,4,580. Right? So the value would be 1,4,580. Now, when we talk about it, the value would be 1,4,580. That means one way is to depreciate it every year differently. Second method, please look at the method very carefully. The second method which you can use for a quicker calculation. This method is applicable only in the diminishing method. So what are we going to do here? If the first year the value was 20,000, reduce that 10%, depreciation rate was 10%, reduce that 90%, would reduce that 10%, whatever is left is 90%. If the value of that was 100 rupees, then 10 rupees is lost because of depreciation. We are left with 90. So 90% of 20,000 is 18,000. Now let's multiply it by 90% again. It would come out to be 16,200. Now, take 90% of it again. First year, second year, third year. For the third year, the value will come out to be 1,4,580. So, in this case, the correct answer is this. This is a quicker method if you just want to calculate the last value. So, just a tip. Now, let's move on. The correct answer is 1,4,580. Next point, in the question, they are asking what is the depreciation for the second year. We just calculated it. It was 1,620. Sorry, first year? No. Right, first year it was 20,000, no? 20,000, first year it was 2,000, right? For the second year it was 1,800. For the third year it was 1,620, right? Then whatever value we get is 1,4,580. So in this case, the correct answer is 1,800 only. This was the first year, this was the second year, this was the third year. I hope it's clearly visible now. Opening value was 20,000. We calculated 2,000 on it. Then for the second year, the opening value, these are the opening values of each year. Right? So let's move on. The next question says, what if the sale price is 12,000? Now we are selling it for 12,000. What was the closing value we had? The closing value was 1,4,580. The closing value is 1,4,580 after the end of the third year, and that is the point when we are selling that particular machinery for 12,000. What I can see here is they are facing a loss. What is the amount of loss? If the book value is 14,580, reduce that 12,000 from here, the value will come out to be 2,580. Right? Just calculate the entire question in your mind. If you are sorted in your mind what particular action of which particular part of the question you are talking about, then the entire question becomes a piece of cake. Right? Now let's move on with the next question. Okay, the question is from the ratios. Debt equity ratio is 3:1. This is a topic which I expect that there would be questions from the ratio analysis as well. Good amount of questions in the examination every year comes from this section, right? So go through the ratios very properly and carefully, because you need to remember all those ratios by their concepts, and since a good amount of things are being learned by you, there can be chance that you can forget it. So it's always better on the last day, give a quick look at all the ratios. Now let's move on and talk about this era. That means we can, the debt equity ratio is 3:1, and the amount of the total assets is 20 lakh. Current ratio is 1.5:1. The owned funds is rupees 3 lakhs. And what is the current asset? What would be the value of current assets? 8 lakhs, 10 lakhs, 12 lakhs, or 15 lakhs. Okay. When we talk about the debt equity ratio, please remember debt means only the long term debt divided by equity. Right? So when we talk about this, what will happen? The amount is given. We have the total long term debt upon equity is 3/1. The total assets is of rupees 20 lakhs. The current ratio is 1.5:1. So I'm writing it here that current ratio is equal to 1.5 divided by 1 is equal to CA upon CL. And the question says what is the amount of the current assets? A weird question because they have given a part of it, not the entire question. Now the question asks what is this owned fund? Owned fund means your equity. So what are we going to do? 3 divided by 1 is equal to long-term debts. We have no clue about the long-term debts, right? Divided by your equity is of rupees 3 lakhs. So we are going to multiply 3 into 3. The long-term debts is of rupees 9 lakhs. Now, let's understand how can we calculate the current assets. Long-term debts plus the short-term debts plus your equity is equal to assets of the company. Whatever assets the company is possessing, that's because they have their own fund, then they have taken long-term loans, and then they have also taken the short-term loans. So on the basis of this, if the total assets the company possesses is 20 lakhs and the equity they have is 3 lakhs, and on the basis of this we have got 9 lakhs as this. So what would be the amount for our short term? So in this case, the correct answer will come out to be, see, this is the point. We have got a debt of 9 lakh. We have got an equity of 3 lakhs. That makes 9 plus 3, 12. And 20 lakh was our total current, total assets. So 20 minus 12, we get 8 lakhs as our current liabilities. Once we get the current liabilities, what will we do? That was current ratio is equal to 1.5:1, where we are not known towards the current assets, but we know about the current liabilities now. So it would be 1.5. 1.5 would be current, there was 8 lakhs now. It is 8 here and 1.5 here. So cross multiply it, 15 into 8, that will give you 12 lakhs. In this question, you have to calculate one part and then you have to calculate the other part. So it is an extended kind of thing. So the correct answer here would be C. See, in this question, there were 3 formulas that we used. So quickly understand all those formulas together. First one was debt, long-term debt upon equity. The second method that we used was long-term debt plus short-term debt plus the equity is equal to our assets. The last method that we used was current ratio is CA upon CL. So all these 3 methods are used for this question. Okay, this was a solution of a question that we have done already, so I'm leaving it here. So let's move on and do the next question. The next question says that the 2 major customer services. Okay, now the 2 major customer committee service that are Talwar Committee and Tandon Committee. Then we have the second one is Rangarajan Committee and Tandon Committee. The third one is Talwar Committee and Goiporia Committee. And then we have Goiporia Committee and Rangarajan Committee. Among the following, which is the most important committees that have been formed for the services, customer services? The correct answer would be Talwar Committee and the Goiporia Committee. So let's understand a little more about these 2 committees. When we talk about these 2 committees, these were formed for customer services. So there it was in 1975, the government of India had appointed the Talwar Committee for the customer services in the banks. And when we talk about in 1990, later on in 1990, Goiporia Committee was formed. And both these companies, committees have played a very important role towards the working of the customer service. Okay, now the next point, that means as per the RBI or BCSBI, the customer service day is to be observed on every dash a day. That means every quarter, every 15th of every month, on the 1st of every month, or once a year. When is the customer service day celebrated? or we can say it is basically observed. It is being observed on 15th of every month, right? So customer service day is observed on every 15th. Moving on to the next question. The main effect of the inflation on the financial statements is, what is the main effect of inflation? Profits are understated, overstatement of assets, adequacy of funds for replacement of assets, or erosion of capital. Because of inflation, what will happen is the inflation will affect our money, and there would be a crunch, because obviously we are spending more on purchasing those items. The expenses are going to increase, the losses are going to roar in the economy there. That means we are losing our capital, because we have to get income, but we have to spend more to get income. That means our profits are going to shrink further, and we are going to be affected by that. That means the profits are not understated, there is no overstatement of capital, adequacy of the funds is definitely normally there, but the problem is there's an erosion of capital, because with inflation, the rise of prices, we have to spend more, our profits will fall and it will start shrinking, then it can also lead to losses. Okay, now comes the next point. This is a point related to a time depository receipt. Mr. X had a 5-year time depository receipt. It's from interest and annuities, module A. The question says Mr. X had a 5-year TDR for rupees 5 lakhs with Bank A maturing on 30th of June 2019. Mr. X suddenly passed away. He died on 1/12/2006. The nominee, okay, this is from the not from the interest and activities, this is also part of module D. The nominee of Mr. X approached the bank. His family members approached the bank, and with the relevant papers for the payment of deposit, the bank should, what would the bank do? Prematurely close the account of that particular person without the penalty, because the person is dead. Technically, the person is deceased. So what will we do with his account? Then pay the amount only on maturity, prematurely closes the deposits and charging the penalty, and then close the deposit and pay no interest. This person is not basically getting all that FD or the time deposits back because of the fact that he is himself taking out that money. The problem is the person is no more, and these assets are now being taken up by their executors or their legal heirs. So in this case, it is correct that prematurely we'll have to close those accounts because the person is no more, and we will not charge any interest for that. Penal interest will not be there. There's no penalty. So correct answer is A. Now moving on to the next question. The next question says the population of a city current year is 24 lakhs, increasing 7% yearly. What will be the population after 6 years? Now this is kind of compounding, because whosoever is born, then more kids would be born over the period of time. So this is more or less not simple interest but compound interest. The question seems to be a little easy, but yes, there's a little trick in it. You need to find out which particular portion are they talking about, right? So the population of the city current year is 24 lakhs, increasing 7% yearly. What will be the population after 6 years? If we have this value after 6 years, what will we do? 24 lakhs is the current one now. So let's add 1 plus 7% every year for 6 years. How can we calculate it? It would be 1.07 and multiplied by 6 for those years, right? So in this case, whatever answer is coming, it would be 1.07 multiplied by 1.07 multiplied by, and whatever value comes out to be, we'll take the principal here. The principal was 24 lakhs, right? So it would be 24 lakhs multiplied by 24 lakhs multiplied by. So in this case, the correct answer would be what amount? Quickly calculate it. The correct answer would be 24 lakhs multiplied by 1.50073. It is 33,601,753. Answer is C, right? Now let's move on to the next question. population of the city is increasing. Now they want to know what was the population before 4 years. Now this is not going further, we are going back. So one rule that you need to follow is whenever we are moving from present towards our future, we always multiply. We use compounding. Right? Now, in this case, what we're doing is we are not moving forward. They want what was the value before. That means we are going backwards. We're going towards the past. Now, if it is multiply here, division would be here, and this is called discounting. So whenever you get confused or you're someone who gets confused normally that what is to be discounted, what is to be compounded, so then what you need to do is that you'll have to calculate it in such a way that find out what is happening with it exactly. Are we going further or are we going backward? So if you're going backward, it would be divided. But what would we divide? It would be again that 7% rate of interest. So increasing 7%, if it is increasing 7%, let's go back to the past and find the answer. Is it A or B or C or D? Trick, this is already there. So this is not the future answer. Now we are left with 3 points. The correct answer would come out to be this is going to be P divided by 1 plus R raised to power the time, or what we call the N. That's what I was telling you. When we go further, we multiply. When we go backward, we divide. Okay. So in this case, the correct answer would be B. That is B. That is 1830943. Shall we calculate this question? Now let's go ahead and try the question. How do we calculate it? The value was 1.07, that too for 4 years. So what we do here is 1 plus 7%, that gives us, it's 1 plus 7%. Okay. It comes out to be 1.07, and we want the value for how many years? That is 4 years. One way is this, the second way is 1 divided by 1.07, and then let's divide the value and take it up for those years. Say first is this one, and the second one that I'm talking about here is this method. Just take it 1.07. Now multiply and equal to, this is the square, this is the square that we get now. We just multiply and then we press on equal to. We are multiplying it with the same amount. Once you get this, press on equal to again. This is their cube. That was square, this is cube, and this is 4 times. So are we getting the same amount, 1.3108, without even clicking on 1.07 again and again and again? So this is the answer. So in this case, what we're going to do is we'll divide it and find the answer here. So in this case, the correct answer is going to be 1,830,943. That means 18,30,943 rupees. No, not the rupee. This is the number of people. So that would be number of people there. Now moving on to the next question. Now they want to know the difference between 4 years back and 6 years forward. So if those 2 points are correct, then this answer will also be correct. 1770810 or 1830943 or 3601753 or the last one 5372653. 563. I'm sorry. So what will be the answer here? The answer here will be B. No, 1830943 was the first one. Okay, now let's go back. It was this much and the original value was 53. It is 36,1753. The answer would be different. We have 2 of these amounts now. So let's calculate this value as well, please. Right? So the correct answer to this question would be, let's look at the points first. I'm taking the calculator. I'm doing it in front of you so that you can actually see how to deal with these calculations. The value will come out to be 3601753 minus 1830943. So the value comes out to be 177. The answer is A. The answer that is given is wrong. The correct answer is A. So let's move on to the next question. This was A. Okay, now let's move on to the next question, please. The next question says, Sahil took a loan for for 6 years. The rate of interest was 5% per annum on simple interest. If the loan of the interest was paid was 1230, what was the principal? Here the principal is not known to you. If you have to use the method is P into R into T upon 100. So what would be the value here? It would be 1230 is your SI. And the principal is not known, but rate of interest and the years is given. The rate of interest is 5 and divided by 100. So in this case, the correct answer would be what? Then we have to calculate it using this method. Just have to go through the solution and it will come out to be 4100. The correct answer is A, 4100. Okay, now let's move on and do the next question. The next question says the FCNR, foreign currency deposits that we talk about, right? So FCNR deposits can be opened in Hong Kong dollars, New Zealand dollars, or UAE dirham, or is it for 1 and 2, or is it for 1 and 3, or 2 and 3, or all of these? FCNR can be opened for how many currencies? As such, for FCNR, we have 7 currencies in which this particular account can be opened. So the correct answer to this question is going to be D. All of these are a part of it. So let's talk about those 7 currencies as well. The correct answer would be D, and on based upon this, the currencies that is included, that is foreign currency non-resident banks accounts, and these accounts are open for depositing the amount overseas, and this is available in US dollars, in Great Britain pound, in terms of Japanese yen, Canadian dollar, then we have the Australian dollars, then Hong Kong dollars. So these are all the currencies which are covered under the FCNR account, right? Okay, so let's move on towards the next question. The next question is regarding the cash flow and fund flow statement. Which of the following statements are true? Fund flow statement is one of the ways of analysis and interpret the financial statements. Second is the cash flow statement is one of the ways to analysis and interpret the financial statements. Then common size statement is one of the ways through which we analyze as well as we interpret the statements. What would be the answer here? Fund flow is one of the ways, that's correct. Cash flow is also one of the ways, that's also correct. And even the common size. See, all these methods are used to understand the various financial statements and their analysis. So technically, these are all financial statement analysis tools. So the correct answer would be 1, 2, as well as 3. All 3 are used. So let's move on towards the next question. Okay. This is the previous answer only, but the correct answer is D. Okay, next question. Who is responsible for any shortage either in the hands or in the vault balance? Head cashier is responsible, or all cashiers are responsible, or the accountant, or all of them? Who is responsible for any shortage either in the hands or in the vault balance? The person who's responsible for this particular is the head cashier. He's responsible for the vault, as well as if there is any cash in hand balance is basically falling short, then he'll be responsible for the same. Next question. Determine the contribution if the sales is 1,50,000 and the PV ratio is 40%. PV ratio is your contribution ratio, that is whatever we are getting in from sales minus the variable cost. See, the point is the cost of the organization that we are bearing can be divided into two parts. One is called the fixed cost, second part is called the variable cost. Fixed cost is the amount that you pay on total, while the variable cost is the cost which varies over the period of time. This kind of question was asked in the examination in the previous years, so that's why I'm covering this portion. This is a part of more or less costing, but still covering it because such question has been asked in the previous examinations, right? So it's always better to go through it. The determine the contribution if the sales is 1,50,000 and the PV is 40%. So what would be the answer here? To get this value, this is contri upon sales in terms of the percentage. It is sales minus variable cost. It gives us contribution. When we talk about the PV ratio, this is contribution divided by sales. So that means if our sales is 1,50,000 and you are looking forward to whatever we are getting as a contribution, that is technically 40% of it. All you need to do in this question is 1,50,000 into 40%. The correct answer will come out to be 60,000. Right? Oh, the value is 60,000. Okay. Now, let's move on towards the next question. It says nomination facility is available for the cash credits, the articles in safe custody or deposit accounts. Is it A, B, C or D? Nomination facility is available for which particular accounts? The nomination facility is available only for the articles in safe custody as well as in the deposit accounts. So in this case, the correct answer is going to be only 2 and 3. Moving on to the next question. The next question says a customer desirous of making a complaint against the bank approaches the staff for the correct procedure. If the particular person is asking the staff only that he would like to raise a complaint against the organization there, so what will he do? What will the employee do? He should help the customer direct to the banking ombudsman, or then is direct him to the RBI, advise customer to the procedure and time limit for complaint redressal. Basically, as a duty only, the employees are bound to help the customers, right? So in this case, the correct answer is going to be they will be advising the customer when and how they can pursue the area of filing a redressal, right? Okay, now moving on to the next point. Then the next point is regarding the trial balance. Good amount of questions can come up in the examination from the area of rectification or from the area of the trial balance. That is, trial balance remains untallied due to the errors. Various types of errors are there: error of omission, error of commission, error of principal, or all these things are errors. That means 1 and 2 is error, 2 and 3 is error, or 1 and 3 is error, or all of these are errors. Among the trial balances, there are certain kind of errors. It's an important topic that should be covered for your examination because questions can come up from this area for sure. Right, when we talk about the trial balance, in terms of trial balance, all of these are errors of a trial balance. Now, since I've given you 3 important errors of trial balance, let's understand all the errors of trial balance in detail, just a brush up so that you know what are we going to deal with in terms of examination as well. There are different kind of errors which are there in trial balance. There are certain errors which can be disclosed. There are errors which cannot be disclosed. So we need to know which particular errors we are working upon. In terms of errors which can be disclosed, that means the trial balance is not matching. That will include errors of partial omission. We forgot about noting down the thing, but not completely. We just forgot to note half of it. The entire portion is definitely not recorded, but half of it is not recorded and half is recorded, right? So then in the next point, they say errors of casting while totaling, we made a mistake. Error of carrying forward, that means once we are taking from one particular page to next page, we made an error. Error of posting in the wrong side of the correct account. Supposed to be debited has been created. Then error of posting to the wrong, to the correct account with the wrong amount. If you are putting it in the correct account, but you are putting wrong amount. It was rupees 100 in case of Mr. Ram, and you have written 100 rupees in case, we have written 1000 rupees in case of Ram. Written in the correct account. Ram is still Ram, but the amount is wrong. Then double posting in the same account. We have written that same entry in Ram's account twice. Errors which are disclosed in the trial balance. Errors which are actually shown in the trial balance is this one, and then which are not disclosed. Let's talk about the ones which is hard to detect. The auditors will come and detect it. That will include complete omission. We forgot about it. Then in terms of errors of recording, while recording 1000 recorded as 100 in only one part of the journal entry, not the entire journal entry. That is there in terms of, that can be disclosed. If the entire journal entry is wrong, you cannot find it out. Errors of recording. Then errors of principal. If asset is noted down as an expense, this kind of question has been asked in the examination earlier as well. If I have repair expenses, it has been noted as a machinery bought. Now, this cannot be found out by the accountant because according to him, trial balance is matching. So, what will he do? The auditor will come up and say, I got the bill. This is not a machinery purchase. This is actually into the repair. So, what are you doing? So, then this would be corrected. Then error of posting to the wrong account to the right side with the correct amount. We are posting it in the wrong account. There can be 2 points. So what we did was we posted error of posting to wrong account. We are just posting it in the wrong account. It was Ram, noted in the name of Sham. It was Rahim, we noted in the name of Nazim. What will happen? Nobody will come to know about it. The trial balance will still match. The debit is still going to be equal to credit. Just the name is wrong, right? And then compensating errors. These kind of errors are the most talented errors which are made, because ultimately if 100 rupees is falling short on the debit side, it is undercast by 100 rupees. The particular person also made the same mistake in the credit side. So ultimately those errors have become neutralized, and because of the neutralizing of this part, you cannot find out where exactly this error originated from. These errors can definitely be asked in the examination, so kindly go through this before you go for the exam, right? Now the next point to be learned is the process known as dash takes the advantage of the opportunity to make a riskless profit using 3 exchange rates. Under this method, in terms of the forex, they are using 3 different exchange rates: forward trading, spot trading, triangular arbitrage, or revaluation. Spot trading means whatever the price at the mark to the market, whatever is going on in the market, we take that particular price. In terms of forward trading, we find the value which is going to be occurred in the future. We have a contract there. That would be there. In terms of triangular arbitrage, written in the name only. Tri means 3. There are 3 parties. We are too scared about the fact that what are we going to do with that foreign currency? So what we did was we took that particular currency and we converted into another currency, then we converted into another currency, because the 3 markets were not closely related. There was a variation in terms of the pricing. So what we did was this. So the answer is triangular arbitrage, moving from one particular currency to another. For example, we started from pound, we converted into dollars, dollars into euro, euro back into dollars. When we are doing all these things, this is considered here, right? Moving on to the next portion. Okay, the next question is regarding Bhim UPI. Which of the following statement is true in respect of UPI? A UPI solution identifies the customers by their actual addresses. Customer identification number is must for utilizing the UPI solutions. Then UPI is not allowed for the customer to have multiple account in various banks, and UPI payment solution is independent from the individual verification address and customer identification number. This is a question from module D. Okay, the UPI payment solutions is basically independent. The correct answer is D. It is independent from the individual verification address and the customer identification number. It's different from that, right? Okay, now moving on to the next question. The next question says, what will be the effect if the sales return is 50,000, posted 48,200? That means it's under cast at the moment. I'm writing it over here. How do we look forward to these questions? Sales is under cast. A credit side is under cast by how much rupees? 1200. That's what I can see. Right? No, 1800. Right? Purchase return for 46,000 noted as 47,200. Credit side is undercast while the purchase side is overcast. This is over and that is under. Now what will it affect upon? Will it be no effect? P&L increases by 36. This is decreased, and P&L increase or decrease by 1800. Any of these can happen. I'm sorry. See, now income is already shown at a lesser amount. That means our losses are increasing, first point. Then the second, we have already noted less of expenditure. That means again the loss should be increased or not. It is in purchase return. Purchase return is our expenses are decreasing. Now our income decreasing, right? And here in this point, what is happening is income is decreasing by 1800 rupees, and at the same time purchase return, that is our expense, is also, the expenses are exaggerated. Income is shown at a lower amount. 50,000 is noted as 48,200 and our expenses are exaggerated. While we were expecting 46,000, while we have given more than that, right? So purchase return, no, this will also affect our expenses to be going down. Expenses are going down there, even the income is going down. Both of these are going to affect the profit and loss only. The correct answer would be P&L is going to be affected. In this case, the correct answer is going to be P&L increase by 3,600. Right? So in this case, that would be the answer. When we rectify it, we have to increase it by both the points. Expenses are declining at the same time. See, why am I saying? Because whatever we have in terms of purchases, if we note the purchase as 46,000, right? Right now we are not noting at 46,000, while we are noting at 47,800. Now, technically, our expense is more. Our expenses are less. Sorry, in this case, the expense is less because this is purchase return. If the purchases are given, purchase is an expense. This reduces our expense. This reduces our expense. So technically, this would have reduced our expense, and already we have, that means it is going to impact the income. Income should be increased, right? Anything which reduces expenses will increase the income, and at the same time, sales is also reduced. It should be increased further. So both of these should be increased, making it 3,600 all in all. Moving on to the next question, it says the net worth of a business as reported on its statement of financial position is the capital plus its liabilities, the total assets minus the liabilities, current assets minus the liabilities, and its non-current assets plus the current assets. Net worth. Net worth is basically the amount which the business is putting in the business, the business person is putting in the business. See, if I said that I put money into the business, that would be my capital plus my reserves and surplus, whatever money is there in the business because I put it or I left it in the business. That's the concept of net worth. Net worth means if I ask you, what do you have? And then you come up and say, ma'am, I have this, I have that. That is the assets that you are having, that you have built with your own hard-earned money. So that means the business is the financial position. Capital and liabilities, these are outside liabilities. When we talk about total assets minus liabilities, and then we have the current assets minus the liabilities. We have non-current assets plus the current liabilities. When we talk about the net worth of a company, what would be the correct answer? Okay, whatever we have built up in the organization, it can be built up with three things. Number one is equity. Number two is the liabilities that we build up, and then this is what we build up, that is our assets. So technically, if you want to take up the equity or the net worth, what will we do? Assets minus liabilities, right? That will give us the capital. What would be the answer there? The answer would be total assets minus the liabilities. Okay, now moving on to the next point. Okay, we are done with this question. It's a repeat. Now moving on. A credit note issued to a customer. When do we issue a credit note to a customer? Informs the customer that the amount of the his account is to be debited with, communicates the customer the discount he is entitled to if he pays promptly, reminds the customer of the offer of the credit and credit offer, and informs the customer of the amount that his account is to be credited with. What is credit note? Under credit note, that means there was a particular debtor that we were having. See, there was a particular person called debtor. He didn't like something. He said that, ma'am, I don't want this particular goods that you have provided me. I would like to return it. I said, okay, if you want to return it, then return it. So if they are returning it to me, then he's not a debtor anymore. If he was a debtor of 10,000 rupees, now we are reducing it by 2,000 rupees, right? If we are reducing it by 2,000 rupees, then from the debtor we are getting 2,000 less. So it would be 8,000 rupees all in all that he has to pay in future. So 2,000 less here means, in this case, the correct answer would be credit note is being issued. We are telling the debtor, now we are crediting you. Now you have to pay less to us. That's the concept, right? So the debtor will not have to pay 10,000. He'll have to pay 2,000 rupees less. That is 8,000 rupees has to be paid by him. Okay, now moving on to the next question. This is D is the correct answer. Now, which of the following is a quality or a quality of arbitrage? We've just talked about arbitrage. We just find out there are two different markets where the markets are not regulated properly or not at least centralized, and we found a particular opportunity through which we could make money, right? So as soon as we found that we can make money out of it, so we'll collect it and we'll make the profits. The correct answer is, it ensures, okay, find out the correct answer please. It ensures that the spot price of the currency will equal the forward price of the currency. The process of buying and selling a currency to make a nearly, because obviously you cannot make it completely riskless, so nearly riskless, and it ensures that the exchange rate in the different locations are essentially the same. 1 and 2 are correct, 1 and 3 are correct, 2 and 3 are correct, or all of these are correct. What's the correct answer, everyone? What is the quality? Which of the following is or are the qualities of arbitrage? In terms of arbitrage, it has no role for the spot price as well as the area of forward price. These are only those things which are to be dealt whenever we are actually dealing with it. If we are dealing it today, spot is important. If we are dealing it tomorrow, then forward is important. Those things are not the points. The point is, there are two different markets which are not exactly aligned together. So we buy things from here, sell things here, and we make a little money out of it. That is what we can say in terms of the process. In arbitrage, what we do is, it ensures the exchange rate in different locations are essentially the same. When we talk about arbitrage, we are just looking forward to the fact that where we are looking for an opportunity, we can make money out of it, and at the same time, in terms of arbitrage, we know that there is a good amount of chance that we can lose money. So if we can lose money, let's create a counterpoint. And if I'm selling something, let's buy something as well at the same time. What if the one particular transaction we are doing can kill us, or it can give us a loss? If one transaction can give us a loss, let's create another transaction which can give us the same amount of profit, because if we lose money in this particular transaction, then there should be something to cancel it out. So more or less, arbitrage is something that means people are basically scared and they create multiple transactions in order to save themselves from the losses. So correct answer is 2 as well as 3. First one didn't make a sense because it was all about spot and forwards. Spot and forwards are not the point in terms of arbitrage. The next point, the level of accounts receivable will most likely increase as. How will the accounts receivable increase? Is it by the point of the cash sales increase, a number of sales, then we have cash sales increase, and then we have the number of credit limits are expanded, credit sales increase, and credit terms remain the same. Credit limits are expanded, cash sales increase, and aging of the receivables is improving. Aging means and how much time they pay us. And then cash sales increase, the current receivables ratio to past due increases, and the credit limit remains the same. One of the best ways through which our account receivables, that means the people who are supposed to pay us, is increasing would be cash sales is increasing, current receivable ratio to the past is increasing. That means in this period we have more people from whom we have to take the money. That is more, and credit limits remains the same. Limit is still the same, but people are given. People have taken more credit sales, and right now they are taking their time to give us the money. So this question is more or less about the point of the confusion in terms of the language, nothing else. Right? The answer is actually here. The credit limits, okay, the answer is B. Sorry. The answer is credit limits are expanded, credit sales increases, right? This would be the answer. Limits are also expanded, limits, the credit sales is also increasing. This won't be the answer. It would be, and the credit terms remain the same. Credit terms will remain the same, but both the limit as well as the sales are increasing. It is cash sales increase. I should have seen that. The question says cash sales is increasing. That will not affect the debtor. Remember, debtor is affected when he makes a credit purchase, not by cash sales, because cash sales will increase the cash. My mistake. Let's move on to the next question. The next question says, what will be the ratio of simple interest earned by certain amount at the same rate of the interest for 4 years and to that of 10 years? That means you have to calculate the simple interest for 4 and 10 years altogether. What will be the value that we'll be choosing? 1:2, 2:1, or 2:5, or 2:3. What would be the answer here? What will be the ratio for this? Okay, let's take it up in this way. We have the same principle, P into R into T upon 100 divided by P into R into T upon 100. This 100 can be cancelled. The principle is also the same. That's not the problem even. And at the same time, even the rate is also the same. So technically, what is left? The time 1 and the time 2. This really simplifies the question. It is going to be 4:10. Then 2 2s are 4, 2 5s are 10. What would be the answer in this case? You don't even have to calculate. All you need to do is think about it. Principal was same, rate was same. So all these things are automatically deducted. What we are left with is 2:5 is the answer there, right? Okay, so let's continue. The answer is 2:5. The next question says, on the basis of the information below, answer the following questions. You are given accumulated depreciation provision for the company that has been at the beginning of the year 2021. Till now, there was already accumulated depreciation. The depreciation which is there in a collective form, it is right now 2 lakh for the original cost of asset, which was 10 lakh. So if I ask you today, if the depreciation is till now 2 lakhs, the value was 10 lakhs. Can you tell me the value today? It is 10 lakhs minus 2 lakhs the value, original value of the asset today after considering the depreciation should be 8 lakhs. Right? The company charges 10% depreciation on straight line basis. So that means till now whatever depreciation we have charged is on 10 lakh rupees, and it is basically what percentage? It is 10% per annum. So technically every year we are charging a depreciation of rupees 1 lakh. Then the company charges full 10% is there. Then on such asset costing, okay, now they say that including those which have been either purchased or sold during the year. So whatever is happening, they charge full depreciation of 10% till now. Now the point is, whatever is there, that means we cannot take this 10 lakh as a basis, because the point is whatever is added, whatever is being lost, all those things are taken together. This method is used by income tax department. Right. Then the next point that comes here is the question says one such asset of rupees 5 lakh with the accumulated depreciation as at the beginning of the year was 1 lakh was disposed during the year. Now you have the knowledge of this particular asset. Along with this, there was an asset which costed rupees 5 lakhs. Till now the depreciation is of rupees 1 lakh. What is the value that we are getting out of it? 5 minus 1, it is currently at 4 lakhs. Now let's look at the point. The question says what is the depreciation which is in the current year if the asset initially costed rupees 10 lakhs. So out of that 10 lakh, 10% should be taken as the depreciation. That 5 lakh and 1 lakh is a part of it, not the major one. See, there are certain things that happen in an organization. What they do is whatever the asset is, right, they add more assets to this block. They call it the block of assets. So assets can be added to the block, it can be taken out of the block. So in this case, we have the total assets of 10 lakh rupees on which we were charging depreciation for years, right? So what we did was 10 lakh multiplied by 10% per annum. That 5 lakh is a chunk of this 10 lakh. It's just a part of it, not the major, right? So in this case, the correct answer would be 1 lakh. Right. The next question says the balance of the accumulated depreciation account at the end of the year considering this year's depreciation. What would be the amount? What would be the amount? Okay, as you know that there was one particular asset that we sold during the year. Let's go back a bit. The answer is 1,50,000, but for that, how do we calculate it? As you know that this particular asset was sold during the one such asset costing rupees 55 lakh with the accumulated depreciation as at the beginning of the year was disposed of during the year. There was a particular asset that we lost. Technically, what is happening is till now we had a depreciation of 2 lakh rupees. With us, out of that 2 lakh accumulated, we are losing a particular asset. We are losing a asset of 5 lakh. Okay, I'm just calculating it here only so you understand what exactly I'm talking about. The total the question is still simple, but it's just that its language is a little tedious to look at. The value of the asset was rupees 10 lakh. Out of 10 lakh, what they did was, out of this 10 lakh, 5 lakh is sold. The depreciation till now that was accumulated was 2 lakh and it is sold. Now 5 lakh is still there and 5 lakh is sold, right? So whatever asset is sold, the depreciation for that particular thing, it's like if the person dies, his soul is lost. So the body will never stay there too. So if the asset is lost, the depreciation provision will also be lost. So from this 2 lakh, 1 lakh is now taken away. What are we left with? We are left with 1 lakh as the accumulated balance of depreciation. But by the end of the year, the remaining 5 lakh, this one is sold and 1 lakh is also taken away, depreciation. Whatever we are left with, 5 lakh still there, and the depreciation shall be charged at 10% of it, because the original cost is 5 lakh and 5 lakh now. So technically now depreciation will be halved, it would be 50,000. So by the end of this year, the 1 lakh previous depreciation is still there, plus the new depreciation to be charged on the remaining balance, that would be 50,000. So in this case, the correct answer will come out to be 1,50,000, right? So this is the question. Okay,